If you are looking for a day trading, trend following trading strategy that you can use on Forex, but also on markets such as crypto, commodities and gold, as I will show you now, then this strategy might be something for you. So let me show you how to set up your charts in TradingView. It's very simple. First, we need a moving average. We can use an EMA, exponential moving average. We open the settings and all we have to do is change it to 100. This is our long-term trend filter. Then second, we are needing the Bollinger Bands. In the Bollinger Band setting, we turn off the basis and also the background, and under standard deviation, we change it to 1. This is all we need. And the setup looks as follows. First of all, the purple moving average is our trend direction filter. So as long as the market is below the moving average, we are only looking for shorts. If the price is above the moving average, we are only looking for long opportunities. We are waiting for a pullback and then we are looking for trend continuations. This is a very common rhythm in trending markets. So what we see here is a very strong bearish push into the new trend direction after the market rolled over. Then we have here a corrective wave. The characteristics that we're looking for in this specific strategy on the pullback is a move outside of the opposite side of the Bollinger Band. Here in this case you can see the correction drives the price up above the outer and the upper Bollinger Bands. That's our filter that we are looking for. In a downtrend, in a strong and healthy downtrend at least, you will see that the market trades outside or very close to the lower Bollinger Band and is typically not able to get above the Bollinger Bands. So this marks our corrective phase. This is the trending phase. What we're then doing is wait for the market to get back and continue the trend direction. We can mark, for example, the last swing low and wait for the price to break into the new low. This happens here. This could have been a theoretical trade entry. We can have our entry here. Stop-wise, you have a few options. For example, if you're an aggressive trader, you can just put it behind the breakout candle or even all the way on the opposite side of the Bollinger Bands. For a target, you can either work with a fixed reward-risk ratio such as 3-to-1, 4-to-1, but if you are after capturing large winning trades in a strong trending market, you can use a trailing stop-loss as well. So what we could do, for example, we start with a 4-to-1 and then we can compare it to a trailing stop-loss approach. We can trail our stop-loss along the outer side of the Bollinger Band or even on the lower Bollinger Band. So let's just see what happens. The market moves lower and because we have set the standard deviation to 1, this will help us as a kind of a trend filter. And what you will see is that during a trending market, the market and the price action will typically stay on the lower side of the Bollinger Band. So let's just see what happens. The market trades lower, we retest the outer Bollinger Bands here frequently, but we're not able to pull inside of the Bollinger Band. That's very important. Here you can see we have our first deeper pullback. That could have been a trade exit. And you can see if you would have exited your trade here, this is a 4.5 reward to risk ratio, which is an exceptionally large outcome and a very good outcome for a trend following trading strategy. If you can trade with a 4.5 reward to risk ratio, you can have a win rate as low as only 25% and still end up making money long term. Let's take a look at another example. Here we are now on a Forex market and the first requirement is that we are having a very strong downtrend. The downtrend should typically extend for an extended period of time and the downtrend should happen outside or at least very close to the lower Bollinger Band. Then you can see we have our corrective phase. The corrective phase brings us all the way outside of the opposite Bollinger Band. It is very important that we don't have a too strong of a push against the trend direction. So the market should typically not be able to stay outside above the upper Bollinger Band in the case of a downtrend. If the market is able to stay above the upper Bollinger Band, that would be as too strong of a bullish signal. So let's see what the market is doing. You can see we are here back inside of the Bollinger Band within just 2 candles. So this seems like a very weak bullish attempt and a strong rejection into the bearish side. So for a bearish entry opportunity, we are waiting for the market to break into a new low to continue the trend direction. This happens here. Again, the stop loss could be placed either all the way above the opposite side of the Bollinger Band, for example here, or in the middle of the Bollinger Band. You have a few options depending on how aggressive you want to be. And then we can use a trailing stop loss approach around the Bollinger Band once again, or you can work with a fixed reward to risk ratio. You can see the trend keeps going and is starting here. So we are going from impulsive wave to corrective phase to impulsive phase again. Let's just follow price action and see what happens. We're retesting the outer Bollinger Band here. but we're not closing inside of the Bollinger Band. That's important. Again, you can see we're rejecting it, but we're not closing inside of the Bollinger Band. Again, so far, no close inside of the Bollinger Band. And you can see the trend keeps going until we hit this area here. So this is our exit now. Let's just see how much this could have made us and how many Rs we could have gotten. So the entry, as we said, is the breakout into a new low after the corrective phase. Let's assume we have a conservative stop loss above the higher Bollinger Band and our exit is here. 2.8, still a very decent outcome. Of course, there are many different ways how you could play this trading approach, and there are many options how you can use a trailing stop loss approach. You can combine it with a fixed reward to risk ratio as well. For example, start with a 3-to-1, and if the 3-to-1 gets hit, then you can take out partial profits and then keep trailing. So you have options as always when it comes to targets and stops. And of course, don't forget, always try this on demo first. Let's take a look at another market, and it's very, very important that first we always need a first strong trend wave. Then we are waiting for a correction outside of the opposite Bollinger Band. So here we are coming in an uptrend and we traded outside or at least very close to the upper side of the Bollinger Band for the most time. Here we dipped into the Bollinger Band briefly, but we never penetrated the lower Bollinger Band. So we didn't have a corrective signal. So let's just keep going and see what happens. So here you can see this is the first time that the market is actually able to close outside of the lower Bollinger Band. The price is still very well above the moving average, so we are still in a strong uptrend. Here now we are back inside of the Bollinger Band within just 3 candles. This is very important. We don't want the market to stay below the Bollinger Band for an extended period of time to still show us overall bullishness. For a trend continuation, typically you just wait for the market to break into a new high. The strong breakout happened here. You can see we had a very nice pattern here. Previous resistance is also turning into support. Once again, we can look for an entry here. Stop-wise, somewhere down here is the usual approach for trend following trading. You don't want to have it too close. We are trading a trend following trading strategy, so very often we can capture large trending moves and therefore we don't have to be too stingy with our stop loss. So you can give your trade some room to unfold. Let's see what happens. The market is retesting the area. We are struggling here a little bit, but we are still staying above the resistance area. We have a good continuation push. We are once again testing previous resistance and it holds as support. Now you can see we are trading outside on the opposite side of the Bollinger Band. So sometimes you will not catch large winning trades and this is very normal. Nothing works 100%, but just let's keep going and see what happens. The market is trading outside of the lower Bollinger Band, but you can see the market is not trading below the lower Bollinger Band for an extended period of time. So we could use that as a secondary entry opportunity. What we do is we wait for the market to break into a new high to give us another continuation signal. The continuation happened here, as we can see, very short corrective phase, just as here, very good overall bullish sign. We're retesting previous resistance, now as support once again, and this time it looks much better. You can see the market did rally much higher. Good trending phase that we are capturing here. The market is now close to the lower Bollinger Band, so we could have used that as our next entry opportunity. This time we don't fully make it outside of the lower Bollinger Band, but you can see we're closing right at it, so a very, very strong rejection. This is a very weak corrective phase. This is a good signal because it shows us there's a lot of bullishness in the market probably. So another entry opportunity into the next trend stage probably, or hopefully. Then you can see the market makes a move higher. We're trending higher, capturing the next trending leg. So you can see it's a very interesting trading approach to capture this back and forth. And you can see this natural rhythm of the market. We have the impulsive wave, correction, impulsive, correction, impulsive, corrective, impulsive once again. So this is a natural way of how many markets will move. So it really pays off to start studying this trend strategy. The combination of the long-term moving average that helps us identify the trend direction and the very fast reacting Bollinger Band as a trend filter are a great combination in a trend following trading strategy. So you will often see that the market moves in this very common way. We have an impulsive trend wave, then we go over into a consolidation, and then we have our next continuation. And this rhythm is so common that you will see it across all markets, and whether you look at long-term trends or short-term trends, you will often find this. So why do we use the different tools? First of all, the moving average gives us the direction. As long as the moving average is pointing upwards and the price is above the moving average, we are looking for long entries into the bullish trend. Then we need to see the consolidation. For that, we want to have a very tight consolidation. The narrower the consolidation, the better. For example, this consolidation, it's much better than this one because this is only half the size. The Bollinger Bands also help us here because the tighter the Bollinger Bands are, the better or the smaller the consolidation is. Here you can see the Bollinger Bands not really narrow that much, and you can see this consolidation is much larger than the second one. Also what you have is here the moving average is not pointing upwards, it's going sideways. So this one is not ideal. This is what we are looking for. We are then essentially trading either a breakout or a break and retest. Both are possible with this trading approach. However, the most important is that we don't only look for a consolidation, but prior to the consolidation, we already want to see a trending move into the direction that we want to trade in. So now you can see we have a bullish breakout, and prior we had a bullish trend wave. And this gives us this very nice rhythm. Bullish impulsive wave, then continuation hopefully again. How you could approach it, there are obviously many different ways, but what you could do is get in on the breakout. Stop loss could be placed either on the other side of the range or on the opposite side of the Bollinger Bands. Here we have a very nice add-on pattern. This is what we would call a spring pattern. Some traders may refer to this as a fake out. What you see is that if we adjust the line here to match the lows, this is where we previously had our low. If we go left, you can see this was also a high point. Then it seems like we had a kind of a fake out attempt. So a breakout that looks very bearish at the point when this is happening. You can also see when this happened, this looks like a double top, right? And then we have a bearish breakout attempt. However, we are not going to go short here. First of all, we are well above the moving average. The space between the price action and the moving average is very important. It tells us a lot about momentum. The further we are away from the moving average, the stronger the market is. You can see this price move led the price so far from the moving average. So there was no reason to go short here for us, since all of our filters is keeping out of those reversal trades. Then we have a very strong period of buying after the fake out. This is what we call an add-on pattern. We already have our signal here with a double top breakout into the moving average direction with a tight consolidation prior. And then this is just an add-on. This makes this pattern even better. Target-wise, you have some options. In the beginning, what I would recommend, go for a standard 3-to-1 reward to risk ratio. So we set our stop loss based on the Bollinger Bands or on the range. And then we just multiply the stop loss distance by 3, and that's where we put our target. Obviously, I would always recommend backtest it first. Don't throw your live money at it. Always backtest it, get familiar with your setup and see how it goes for you. We have a breakout and a retest. You can see the market is for now moving back into the previous resistance, might be becoming support. If this level holds, we will stay in the trade. If we fall below that, we can think about lightening our position, which means getting out maybe 25% or 50% of the position, or we're just going to hold it as long as we believe our analysis is still correct. You can see we have this rejection pattern, pin bar. We are struggling here a little bit, but you can see not much bearishness going on. We had a very strong bearish candle here, but this was the retest candle, prior resistance turned into support. The pin bar, very small indecision candle. Then we have a small bullish candle, and then this is what we call acceleration. So we have deceleration, acceleration, that's how momentum works. Now we have a lot of bullish power coming back into the market. Overall, this looks very bullish now. And what we see now is the market pulling away. Another very important thing is that in a bullish trend, what you will often see is that the market stays outside of the Bollinger Bands, especially if you have the Bollinger Bands set to a 1.0 standard deviation. The regular common standard deviation on a Bollinger Band is 2.0. There you will often see that the price action will fall inside of the Bollinger Bands. However, with the 1.0 standard deviations, you can use this as a trend filter. As long as the market is outside of the 1.0 standard deviation, you're looking at a very strong bullish trend. What we see now is the market is pulling and pushing through our target. In this case, you would have reached your 3-to-1 target. Another way for your backtest, what you could be trading or trying is to scale out maybe at this area 50%. So you set your target, and then when the market gets there, you scale out 50% if the price is well above the Bollinger Bands. This could be a filter. If you see that the market is struggling at your target and you are already trading very close to the Bollinger Bands, then I would recommend take full profits. However, as long as the market is moving higher and staying outside of the Bollinger Bands, this is a very bullish looking market. Let's just see. You can see we dipped into the Bollinger Bands, but just rejected it briefly, never closed inside of it, which changed now. You can see this is very different. Now we're closing inside of the Bollinger Bands. This could have been your exit signal if you would have chosen a different target approach. So on this one, you can see this would have been a 6.5-to-1 reward to risk ratio, and here you could have scaled out at 3:1. Of course, not always will you get such big trends, but if they do, then trend following really pays off.